Welcome. This is Chapter 1, Accounting and Business, following the book from Financial Accounting Fundamentals by John J. Wild. We're going to cover a lot of material in Chapter 1, but it's important that you understand all of these concepts so you're successful throughout the entire class. The first thing I want to make sure you understand is that accounting is an information and measurement system. It identifies, records, and communicates relevant, reliable, and comparable information about an organization's business activities. So what we're going to do is work on actually identifying transactions, making sure that we know what kind of transaction events are worth recording, which leads us to the next step, which is actually recording things in a log or a journal, and then how to communicate those findings through financial statements. Accounting is often called the language of business. That's important to know because all organizations set up an accounting information system to communicate data to help people make better decisions. And I usually tell students that it's a foreign language more than it is math because it actually takes a lot of practice to know how to translate an activity into a book called the general journal, and then to ledgers so that people can understand it. Something important to keep in mind as we go through this class is also the fact that accounting information is important to a lot of different people, including external users like investors and lenders who use accounting information about a business to decide whether or not to invest in the business or to give a loan, and then internal users, probably what you're more familiar with, internal users like managers or the CEO or CFO that use the information that accounts provide to actually make decisions like where do we cut expenses and what's our future sales forecast. So they'll use that internally to make decisions. Financial accounting is governed by concepts and rules known as generally accepted accounting principles, and that's shortened to GAAP. You'll hear this for the rest of your business education, the word GAAP. As we start to talk about how to record transactions, there's a lot of rules that are set forth for us so that we know how to actually record transactions. Our U.S. government, through legislative action, has deemed the Financial Accounting Standards Board the creator of all the rules we must follow. So there's actually a body governing these rules. And these rules help ensure that the information is relevant, reliable, and comparable. You'll see those terms show up again and again because it is important that users have reliable information, they can use it to compare different companies, and that it's relevant. The accounting equation may be the most important thing you learn in this class. If anything you take out of financial accounting, at least know that assets equal liabilities plus equity. When I said accounting is a foreign language more than a math, I still mean it. And the fact that you'll need to become familiar with what each of these terms means, the assets, the liabilities, and the equity before this equation or anything else in this class will make sense. Assets are a resource a company owns or controls. Examples are cash or supplies, equipment and land, anything that carries expected benefits for the company. The claims on a company's assets are separated into owner and non-owner claims. Liabilities are what a company owes its non-owners or creditors in future payments, products, or services. And equity, which is also called owner's equity or capital, that refers to the claims that the owners have to a business. Together, liabilities and equity are the source of funds to acquire the assets. Let me give you an example. A pizza delivery company has a car as a resource, and the car cost $1,000. Okay, so the car cost $1,000. The car is an asset. It's a resource to the business. So what if I told you half of the car was purchased on a loan? Therefore, half of the car, $500, is a liability because it must be paid back. Okay, so again, that's the amount that other people have, their stake they have in the business. Amount that must be paid back. And then the other half was paid for by the owner. So $500 is equity. Okay, so again, a $1,000 car was used in the business. Half of it was bought on a loan, so it must be paid back, so somebody else has claims to it. And the other half, the owner invested to buy that car, so it's equity. This equation can be broken down further by the next equation. Equity, or the owner's claims to a business, are either because the owner contributed something to the business, or because of the earnings from the business. From normal operations, they actually made an income. And then to go one step further, because we'll focus on corporations in this class, the amount contributed by the owners is stock that they buy in the company. And the amount or earnings retained each year is the difference between what the owners take from the business, which is what we call dividends, and the net income, which is revenues minus expenses. That's a lot of vocabulary, and don't forget I posted notes for each of these chapters to help you through all these vocab terms. Before we start looking at individual transactions for accounting, I want to introduce you to the fact that every transaction there is a give and a get. This isn't technical, it's not in your book, but I use it to help me walk through transactions, and I think it'll be helpful for you too to know that every transaction is a give and a get. We're going to look through the transactions that are in Chapter 1 of your book, 1 through 11. As we go through all of these, make sure you understand what's going on here in each one, because we're going to keep revisiting them. Write them down, practice over and over again. You'll see these in the homework, and you'll see them on your exam. Okay, so let's start walking through the transactions from your book. We're going to use these transactions to see how they affect our accounting equation we just talked about. The first thing your book introduced us to is that Chaz Taylor invests $30,000 cash to start a company. This is a real transaction. Chaz invested $30,000. That's important. It's financially important. It's monetarily important. We need to record it. Because we focus on corporations in this class, the investor must be a stock owner, because that's who contributes into a business for a corporation, stock owners. Therefore, he's giving the business a resource. He's giving the business cash in this example, and he's getting stock out of it. Okay, again, because this is a corporation, and it's just implied. This is a corporation. If someone invests money, they must be a stock owner. So we're going to assume he bought stock. He gave cash. He got stock. Cash is a resource, and so it's an asset. The business is going to be able to use it. And because stock is an equity account, we're going to look at the fact that equity is going up. And again, this is, for some people, this might be really easy to understand, and some of you might just need to memorize that what's going on in these transactions. You're going to see the same type of transaction over and over again. So going back to that accounting equation, Chaz invested $30,000 cash to start the business. So here's our equation. Assets equals liabilities plus equity. And I'm introducing some different accounts that fall under each one of these categories. Cash, supplies, and equipment are types of assets. They're resources. I want to introduce two other accounts here. These are the liability ones. Accounts payable is the amount that it's owed to creditors when supplies or inventory is bought on account. And notes payable, which is the amount owed to usually banks when a loaned dollar amount is taken out. And then equity, the only one here we're going to worry about right now is stock. So transaction 1, what happened? Cash went into the business. Equity was also created here for $30,000. And look, we're in balance. Assets went up $30,000, and the other side of the equation, equity went up $30,000. Let's try another one. The company purchased supplies by paying $2,500. The company gave cash. They gave cash. They got supplies. A give and a get. Gave cash, got supplies. Well, in this case, we're getting rid of cash. So the cash will actually be going down, but we're getting supplies, and that's going up. And both of these are resources to the business. So they're both assets. Okay, so number 2, we're going to add this to our little chart. In this case, cash is going down. And see here these brackets? This is an accounting way to say negative or going down, a decrease. Cash is going down and supplies are going up. And they're on the same side of our accounting equation. They're both assets. They're both resources. No effect to liabilities and equity. but the assets are net zero. And if you looked at total assets in this case, what happened with when we took transaction 1 and 2 combined them? We started with $30,000 asset increase, went down $2,500, went up $2,500. Our assets in total are $30,000. And there was no change in transaction 2 for our liabilities or equity. So the only thing that happened on the other side of our equation was that equity went up $30,000. So our equation is still in balance. This transaction is similar to the last one we recorded. Here we're going to purchase equipment by paying $26,000 cash. Cash was given and equipment was received. The asset account cash will go down because cash is being paid, and equipment will be going up because we received equipment. So cash goes down, equipment goes up, gave cash, got equipment. Both of those are assets. So here we see the cash is reduced by $26,000 and the equipment goes up $26,000. We have a current balance in the supplies account of $2,500. And equipment has a balance of $26,000. I'm just doing a total down here at the bottom. Once again, there was no change to the liabilities or equity side of the equation for transaction 3. In our next transaction, the company purchases supplies of $7,100 on account. The word on account means that it will be paid for later. So if you've ever heard your grandparents talk about going to Sears and Roebuck way back in the day and buying things on credit, it's essentially the same thing as buying something on accounts. They made a vow to pay for it later. And here supplies were received with a promise to pay later. The asset account supplies goes up. Supplies were received. But what was given was a promise to pay later, and that's accounts payable. It's just another term you're just going to have to know. Accounts payable means a liability when someone says they will pay later for supplies or inventory they bought on account. And in this case, the liability will go up because it's someone else's claims to the business. So here we are in transaction 4. We purchased some supplies on account, which means supplies went up, number 4, and then the liabilities went up. So the amount that someone else has in the business went up. The claims somebody else has, that's what the liabilities mean, $7,100. At this point, we have not looked at transactions involving revenues, expenses, and dividends. And so in the next few slides, we're going to address some of these new accounts. The company rendered consulting services to a customer receiving $4,200 cash in full payment. And this is a new concept. The company did work for somebody and received a payment. When services or sales are rendered, the company earns revenue. Here, the asset account cash will go up because cash was received. And what was given was an actual service. And we call that revenue, okay? So again, if services or sales have been rendered, then what has been earned is a revenue. And it's an equity account. It makes our equity go up. That's a good thing. And when we analyze our transactions, we see that number 5 here, our cash has gone up $4,200, and then revenue has gone up $4,200. So assets went up $4,200, and then the other side of the equation of liabilities and equity, the equity went up $4,200. And if you were to total the balance in all those accounts from all transactions, beginning balance $1,500 for cash plus $4,200 equals $5,700, and do the same for each account, you'd see that again, assets still equal liabilities plus equity. In this next one, the company paid cash rent of $1,000 and salaries of $700 to employees. This is a transaction where we've actually got 3 things going on. And that's okay, as long as at least 2 accounts are always affected. In this case, we have 3. the asset account cash is going to go down because we actually paid, or the company paid rent, $1,000 of rent and $700 to employees. So cash is going to go down. Gave cash. But what was received? Well, in this case, we've got rent and we got the employees to work for the company. Expenses are the cost of doing business. And they, in this case, are going up. But the equity goes down. Expenses make equity go down. So even though expenses are increasing, equity is not. Equity is going down because at the bottom line, net income will be going down. So in this case, transactions 6 and 7, we combined them. Paid rent of $1,000, cash went down, and expenses, although they're going up, makes equity in total go down. So that's why you see the brackets, because equity is going to go down. And then the cash to pay the salaries goes down, and the expenses for paying those employees are making our equity go down, $700. Here the company provided consulting services of $1,600 and rented its test facilities for $300 to a customer. The asset account, accounts receivable, is kind of the opposite of accounts payable. It's the amount that will be received by the company from customers. So if customers promise to pay later, then they are going into the accounts receivable. The promise to receive money later, as opposed to pay it later. So the customers will owe the company $1,900, which is an asset. The asset will go up. Revenue, because the actual service was provided, the equity will go up. And then rental revenue will go up. So you can see there's two different ways we broke it out. We want to separate the types of revenue so we know exactly what kind of service was provided. So consulting was done, rental revenue was earned, and then the customer will pay later, so accounts receivable. And if we analyze our transaction, accounts receivable, it is a resource to the business. Customers will pay later, $1,900, and the revenue earned was $1,600 from consulting and $300 from facilities. If the client in transaction 8 pays $1,900 10 days after the customer has been billed, then what happens? Well, now the customer decided to pay. That's great. Then cash will be received, and that's an asset. Now the amount the customer owed, the amount that was promised to be received later, that's going to go down because they paid it off. So $1,900 in cash going up, $1,900 in the amount the customers owe us go down, or owe the company go down. And we're still in balance. Fast Forward pays $900 as partial payment for its earlier purchase of supplies purchased in transaction 4, leaving $6,200 balance unpaid. So the $900 that was promised to be paid later, that was in accounts payable to another company, was now paid off. So cash will be going down. And the amount owed to an outside source will go down. Cash goes down, and accounts payable goes down. The board of directors decided to pay a total cash dividend of $200. A dividend is the way that owners in a corporation get paid out. It is a good thing, but it makes the equity go down because money is being taken out of the business. So if dividends are paid, then cash will go down, and dividends will go up. Although dividends are kind of like an expense, and even though dividends are going up, they're going to have the negative effect on equity because they make the total equity of the business go down. So in number 11, cash is going down, and then dividends are going to go down. So in number 11, cash is going to go down, and equity will go down. Dividends are going up, but yes, equity is going down because the actual equity is being taken out of the business to go to the owners. and the equation is still in balance. If you're like me at this point, you're probably wondering why there's so much information in Chapter 1 and what we're going to be doing going forward. Our end goal is to produce financial statements, or basically summarize the information in a way that's easy to understand, and so others, internal and external, can understand and make decisions. In Chapter 1, we are introduced to analyzing transactions, and that's where we're at right now. We just talked about analyzing those transactions. Then we'll talk about recording. So if a business buys some equipment paying cash, how do we actually record that? Then we'll move on to summarizing all that information and making financial statements. I have an example on this slide of some notes a person made about changes from last year to this year on their financial statement. So last year and this year and what happened year over year. And really, that's our end goal. That's what we're working towards. We want to start from the fundamentals and move our way all the way down so that we can produce these statements. Use them to make decisions and to provide information to others for decision making. So the last thing I want to introduce you to is financial statements. And there are several steps between, again, analyzing them and creating them. But just become familiar with the first, or really the main 4 financial statements that you need to know about. The income statement, which describes a company's revenues and expenses, probably the most important one, because most people use this to understand what kind of net income or net loss a business has earned over a period of time. Then we'll talk about the statement of retained earnings, so the changes in equity from either net income or if any dividends were taken out. Then the balance sheet. It describes the company's financial position, what kind of assets, liabilities, and equity there are at a point in time. And then statement of cash flow. So how does cash flow in and out of a business over a period of time? And that's the end of Chapter 1.